This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Number one, I love your show. I love, the way that you go deep into business and then go, on some of these other tangents of experiences that as business people we all have. So thank you for putting out such good content because it's impactful. It is really impactful.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 2123, and thank you for joining me, Empowered Investors. First, I want to remember to mention a couple of important housekeeping items for you. Number one, for those of you pro members, we have our regular Zoom meeting on the first Tuesday of every month. But for the rest of you and the pro members, we want to develop a cadence of having a regular Zoom meeting for you, like we did with our Alabama local market specialist just recently. We want to do that on the second Wednesday of every month. So look for future announcements for that. Second Wednesday of the month meetings. Just kind of mark your calendar vaguely for that. I believe those are at noon Pacific time and 3 p.m. Eastern time. So you can join us for that. And if you're around the world, hey, look, I can't say every time zone, but you can figure it out. You can. All right. Another very important item I've been meaning to mention, and I've been remiss, I've forgotten about this, is it is really important that all of you check with us constantly, talk to your investment counselors on a regular basis, because some of those local market specialists that we recommended a few years ago may no longer be good. Look, just like food in your refrigerator, folks, it goes bad after a while. And sadly, that is what happens with a lot of markets and a lot of local market specialists, a lot of people. Some of these teams we're dealing with, there is this kind of life cycle in the relationship, right? Where at first they say things to me like, Jason, you changed my life. My whole business is exploded since I met you and started working with you and your team. And it's been phenomenal. So the next stage in the relationship is they get too busy and they can't handle all the business we sent them. And then the stage after that in the cycle is the arrogance stage. Well, I've got so much business. I'm making so much money. I don't need you and your referrals. And this is usually the fall, folks. This is when they fall apart, right? Napoleon, there's a great Napoleon quote that I have really tried to live by, and that is, write this down. It's so good. This is such an important quote because we all have the same parts of our human nature, right? I'm not totally faulting these local market specialists for being the way they are and the property managers for being the way they are, but it's just human nature. Here's the quote. The most dangerous moment comes with victory. Think about the brilliance of that quote, everybody. The most dangerous moment comes with victory. That is the moment when we win, when we become complacent, we become ungrateful, we become arrogant, right? That is the moment life falls apart. That is the moment business deals fall apart. That is the moment we fall on our sword. And if someone is smart, they will internalize that quote that the most dangerous moment comes with victory. That is the time we are the most vulnerable because we start believing our own hype, right? And we got to guard against that and make sure we never become complacent, ungrateful, or arrogant. Super important thing about life. I have seen this pattern repeat itself so many times, and I will admit it, I've seen it in myself at times. So you never want to let that happen. And a great example of that is that giant court case that I won just a year and a few months ago, where I got this $56 million jury award against a competitor. What happened with that competitor? And by the way, we did a whole show on this. If you don't know the story, it's really a truly amazing story. We did a whole show on this where my lawyer was on the show and he explained the whole story. It's really a fascinating case. But what happened is this competitor and his cronies became very arrogant. And they thought, Jason Hartman and his companies, they're just stupid and they're not what they say they are. And, so they wrote all these bad things about me online that just were complete lies and fabrications. And they probably thought they would walk into that courtroom in federal court and the court and the jury would just rule in their favor. But they really just did not understand how arrogant they were being and how if they would have just simply stepped back and maybe kind of like looked at things from another angle. You always want to try and walk in the other person's shoes, right? That's the old saying, walk in the other person's shoes for a mile before passing judgment. So you can really gain perspective, and that will eliminate the arrogance, the complacency, the ungrateful attitude, right? And so this is just really important, right? There's so many examples of that. We see it all around us every day in our own lives. We see it in business. We see it in relationships, both friendship relationships and intimate relationships. It's just the way things are. It's human nature. And look, we all have human nature, but we've got to guard against our human nature sometimes, right? Okay. So before we get to our main segment today, I want to share with you something from your favorite website, jasonhartman.com. and that is, we've got a property we just posted on the website. And this property is a really good lesson. And so I want to just sort of go over it with you today. It's one property, but it is 3 different proformas on that property based on 3 different things. And this is an expensive property. For a rental property, this would definitely be at the higher end, Class A type property. And, on a property like that, the cash flow numbers just aren't going to be as good, right? But the appreciation is going to be really good, right? So, that's the usual scenario, that you sacrifice monthly income for a better tenant experience and more appreciation in the future. And so this property is kind of an example of that. It's in a very top-notch market, really one of the most desirable markets in the country over the last few years, and that is Sarasota, Florida. A more expensive market, right? We've got less expensive markets like Memphis, Little Rock, Indiana, or Indianapolis. These markets, or Northwest Indiana, right? We've got less expensive markets where the numbers from a cash flow perspective look better. And the interesting thing is, pretty much on all these properties, we just estimate and project in the future the same amount of appreciation, even though that likely will not be the case. Some properties will appreciate better than others, but since we don't really invest with appreciation in mind that much, we're sort of the prudent, conservative investors that look more at just the ongoing numbers of the deal. You just have to take that into account and kind of adjust for it. But here's the thing I want to show you about this property, okay? It's got 3 different proformas based on a very interesting creative financing option where you could buy this property subject to the existing low rate mortgage at only 4.375%. I know, that's fantastic. That's a way better deal than you're going to get on a brand new mortgage today. But the property has a good amount of equity in it. So what do? Do you just put cash down, a big chunk of cash into the deal, and then assume, or not assume, but take subject to that existing loan? Well, you could do that. Or you could have the seller do a carryback where the seller carries a portion of that. You put a smaller down payment. And these are the options I want to go over. 3 options. So let's look at the proformas. Hopefully you're watching this on video. It's kind of good to see on video, but I'll try and outline it if you're listening on audio only. So here is the first proforma on this property. Now, this is the lowest down payment option, offering the best leverage, right? And remember, leverage is good, regardless of what anybody says. I've explained that ad nauseum, that when you have the leverage, as long as you manage it correctly, you're going to do better. It's just a better thing to have the leverage, right? But you got to sacrifice the cash flow. So look at this property. This is a more expensive property, okay? $549,900. The initial cash invested would be about $93,000 on this deal, with taking subject to the existing mortgage, which is 63% loan to value, and having the seller carry back 22%. So you get in with less money down. Now, the overall return on investment is projected at 33% because that takes into account everything except one thing, which is inflation-induced debt destruction. That is not calculated on the proformas. So that even makes your return on investment better, but that's a longer discussion we don't have time for because we got to get into the meat of today's episode. So cash on cash return is negative 9% because you have negative cash flow, otherwise known more correctly as deferred down payment, because you're getting a lot of leverage on this deal. Okay. So the cap rate, though, is pretty solid. It's 4.5%. In this market, that's not a bad cap rate at all. Now, I've seen much better cap rates in other markets. I've been doing this for decades. And right now, these cap rates are compressed because we're in a market where the prices have gone up quite a bit, as we all know, right? We don't need to talk about that. So this is the projection of the deal I would want to do, right? Because here I have the best overall return on investment projected at 33% annually. And as I always say, even if it only goes half as well as expected, your return is going to be what? 17.5%. That ain't bad. Okay. Even if it only goes half as well as expected. All right. That's one way to look at it. Same property. Let's look at it with 25% down. Now, with 25% down, because this is a more expensive property, the rents are still lagging the prices. They have not gone up that much yet. The projected rent here is only $3,200 a month. By the way, this property was previously rented for $3,400 a month. I don't know. Maybe that's because it was brand new then. It's only like 3 years old. Or, maybe we've seen a little softening in the rents because of the oversupply in the apartment market, which bleeds over a little bit into single family homes, but not that much. And remember, this is with a property manager charging 8% per month. We recommend self-management. That would obviously make the deal much better as well. Okay, so here we have a deal where the overall return on investment is projected at 24% annually, and the cap rate is still 4.5% because it doesn't consider financing, and the cash on cash return is negative at a lower amount of 2%, and deferred down payment or negative cash flow, $279 per month you're still putting into this property. But what happens after you refinance the property? Now, let's assume the property does not go up in value, that in a year or 2 years, you get rid of this seller carryback that is at a high interest rate of 10%. The first loan is at a very low interest rate of only 4.375%, but the second loan in both examples I've given so far is 10% for seller carryback. But that's a $550 a month payment, but it's only 12% of the overall value of the property. So now let's look at the post-refi projection, assuming that the market value stays the same. The property is the same value as the day you bought it. It doesn't even go up, right? Okay, so on Monday's episode, I am going to show you the after refinance projection. And I think you'll like what you see. Maybe not. We'll review these two options of the initial purchase quickly on Monday's episode, but then we'll do the after refinance projection, getting rid of that second loan. Okay. So that's coming up on Monday's episode. In the meantime, be sure to register for our Empowered Investor Cruise. Just go to jasonhartman.com and you can do that. And now let's talk about linear, cyclical, and hybrid markets and a bunch of other things. And you have me teaching you this. So here we go.
Now, guys, I'm super excited to introduce you to Jason Hartman. I'm going to kind of hand the mic to you because I believe for all of you newbies out there that are trying to figure out when I should be getting in, I'm telling you, and we're going to support it with Jason right now, like today. Hurry up because, the best time is today. It's not yesterday or tomorrow. It's today. And so, Jason, I'm going to give the mic to you. Let's just talk about kind of the supply and demand issue.
Sure. Happy to dive into that. Just to comment on what you said, I'm not sure it's the best time. I think it would have been better to buy 2 years ago, obviously, right? When you could have locked in a 30-year fixed rate mortgage at around, 3%, and you would have had a lower price on the house too. Now, the housing market has become much less affordable. However, the general research over lots and lots of decades and lots of asset classes show that market timers fail. Okay? The investors that win the game, regardless of the asset class, are not the people who are trying to outsmart the market, not the people who are trying to time the market, because I'll give some examples of how the market timers have definitely gone wrong. They're the people who invest. If someone watching or listening to this calls themselves an investor, well, then you're supposed to be investing, as the name would imply, right? Now, market timers that try to speculate and outsmart the market, they just never really win. And look, I've been doing this a very long time, longer than almost anybody you'll talk to. I remember back 18 years ago, right, when I got into the investor-only business. Before that, I owned a traditional real estate company. I sold it to Coldwell Banker. It was in Southern California. Then I got back to my first love after that. I had a local non-compete agreement. So I thought, I want to help investors build nationwide portfolios of properties. And I'm still doing the same thing. 100% investor business for the last 18 years. And so many people coming out of the Great Recession, for example, by the time you got to about 2011 and 2012, they were saying, oh my gosh, the market's recovered a bit. We're going to have a crash. It's not the time to buy. It's going to have a downturn. And then those same people were saying that in 2014, 2015, 2016, 2018, 2019. And then, of course, they were all predicting a crash in 2020 when COVID hit. And they were saying, now is the time to keep your powder dry. I'm glad I have a little cash because in a few months, we've got the end of the world here. I'm going to pounce on every deal. I'm going to buy as many properties as I possibly can. And the exact opposite happened. We had a giant run-up, a historical run-up in prices. So look, we are definitely in a time of transition. Real estate is a credit-based asset class. The Fed has increased rates dramatically, so much so that this is a historic increase in interest rates. And everybody listening or watching this should be amazed at how incredibly durable and resilient this asset class has been. We've seen interest rates nearly triple, and yet we don't see a housing crash. Like, that should blow your mind.
Yeah, exactly.
That we have not seen a housing crash. Now, everybody said we would see one, yet our inventory levels are so low. Let me give you a comparison. Now, just understand that there are a couple major data sources for housing inventory. One is the National Association of Realtors, but I don't use their statistics, and I'll tell you why. Because when they count current housing inventory, they count pending sales, contingent sales, and for sale properties. I like to use Altos data because they only count actual for sale properties, a property you could buy today. Now, you can use either one as long as you use the same one over time, because all you're looking for is the trend line and the comparison. You want to answer what I call life's most important question, which is compared to what? Okay, so that said, with the Altos data, the inventory levels at their lowest point during the savagely competitive housing market during the COVID era, we got down to about 240,000 homes for sale.
That's wild.
That was incredibly scarce. Remember, This is a country of 332 million people. And how many houses are there in the country? There's about 140 million of them. So out of those, we only had 240,000 for sale. Okay, what most experts would agree on as a normal market is 1.2 million homes for sale.
Wow.
So now, with interest rates nearly tripling, we have a little more inventory, but it's only a little more.
That's right.
How much do we have? We have about 460,000 homes for sale now. Still, a shortage, I said shortage, of about 700,000 homes to just get to what the experts would agree on is a normal market. That is not a buyer's market. It's not a bad market. It's not a crash. It's just a normal market is 1.2 million. We only got about 460,000. So we are in an inventory shortage that is really terrible. It's not the worst it's ever been, but it's close. Okay. Now, why are we in an inventory shortage? And why will we have a savagely difficult inventory shortage for many years to come? Well, our friends at the Federal Reserve, led by Jerome Powell, what I call a poison pill into the real estate market during the COVID era. And what is the poison pill? Well, when I say poison pill, most people hear that thinking, oh, that means the market's going to crash. No, it means inventory is going to remain tight. That's the poison pill. A savagely unaffordable housing market for literally decades to come. The poison pill is low interest rates. Because the vast majority of the country either purchased a new home or refinanced their home during the COVID era when we had literally, Justin, the lowest interest rates. Now, don't laugh because I'm going to back this up with data. In 5,000 years. Yes, there are actually statistics back to ancient Egypt on interest rates and borrowing. And if you read a fantastic book by the late David Graeber, I wanted to interview this guy. He passed away. I never got him on my show. He wrote a great book, though. It's called Debt, the First 5,000 Years of Debt. And in it, he talks about the interest rate history, 5,000 years. That's what we just experienced, the lowest interest rates in 5 millennia. Okay?
Wow.
That was a complete abnormality, and we all know it, right? Now, I think the Fed will probably pivot, and we will see rates settle in somewhere in the 5% range. But my disclaimer is interest rates are incredibly hard to predict. So
right.
I could be wrong. I don't know.
Yeah.
But regardless, as long as we don't have rates as low as they were during the COVID era, we are going to have a big housing shortage because these people that got these low rates, guess what? They have 28 years left on their mortgages. And that mortgage, just like a bond, a mortgage acts like a bond. So how does the bond market work? Well, when interest rates go down, bonds go up. When interest rates go up, bonds go down in value. Why is that? Because a bond is just the flip side of a loan, okay? And so when a company issues bonds, corporate bonds, if they issue those bonds at 5% and interest rates go to 7%, and now the new bonds being sold are at a higher rate, well, that makes the value of those old bonds lower because nobody wants to take a low rate if you're trading the bond, right? And the opposite happens in the opposite way. So all of these millions, tens of millions of mortgages out there that are currently held by homeowners have actually become a giant asset to them. And they don't want to give up that asset because they can't move it to a new property. So they're stuck. It's kind of like living in a rent-controlled apartment that is such a good deal that even if you want to move, you just don't want to give up your great rent-controlled apartment, okay? And that's why rent control is a disaster because it distorts the marketplace. So this is a chart of all of the existing mortgages in the United States of America by rate, by interest rate, and percentage. And what it basically shows us is that about 25% of all the mortgages out there are at or below 3%. And about 65% of all mortgages out there are at or below 4%. These people have an asset that has increased in value and they don't want to part with that asset. Now, is it possible for anything, to be more valuable to the owner of the thing than it is to the marketplace in general? Of course it is. My dog, for example, right? I love my dog, right? Great dog. You know, many of us have pets that we adore, right? Well, my dog is more valuable to me than it is to anybody else, right? Okay, I might have a sentimental item, maybe a piece of jewelry that my grandmother owned or something, right? That's more valuable to me than it is if I just sold it on eBay, okay? So that's the way it is with the housing market, because the houses that have the existing mortgages are more valuable to the current owners than they are on the marketplace. And when that occurs, the owners won't sell them. And that's exactly what they're doing. Now, keep in mind, I predicted this in early 2020 when COVID was just getting its foothold, because I thought, these people are going to have these mortgages as the Fed was lowering rates, historic, rate cuts, right? I thought these people, they're just not going to want to part with these houses because if they do, they lose the mortgage at the same time. And so that's what's happening. That's the poison pill. The poison pill is lack of inventory. It's not a bad market. Look, one rule of life we have to always know is that if you want to have a housing crash, or if you want to have a crash in any type of asset class or any market, you have to have highly motivated, distressed sellers. And the chances of anybody being in distress when they have an ultra cheap mortgage is very low. And
That's right.
They're just not going to want to part with these houses. Now, here's what I didn't tell you and what the chart didn't tell you. That showed the mortgages that are out there. But you know what it didn't show us? It didn't show us all of the houses, because 42% of all homes in America have no mortgage at all.
You said that yesterday. I'm going to pause you for a second, because that's where my mind went like, oh my God. So if we have 330 million, I believe you said was the statistic of
people.
Homes.
332 million people, about 140 million housing units.
And 44% of those housing units don't have a mortgage at all.
No mortgage.
So this is where I'm just going to step in, because
how are those people going to get into trouble? Tell me where, like, some of these idiots out there are just predicting this giant wave of foreclosures.
Right.
Okay. Like, where will they come from? Are they going to come from the 25% of people that have a mortgage at or below 3%? Are they going to come from the 65% of people that have a mortgage at or below 4% super cheap payments on a nice house? Are they going to come from the 42% of people that have no mortgage at all? Well, like, who's going to get foreclosed on?
Yeah. It's interesting. So the marketers are out there screaming this, right? To your point of fear porn, right? It sells, right? So it is what it is. But this is why I'm so, I mean, I could probably have you on every week if you wanted to do that, because I want all my listeners to understand what he is saying, right? And hopefully you guys watched that, because that graphic is really important. But let's just use, and the question I'll have for you is that 65% that are 4% and under, is it inclusive of the 24%?
Yeah.
Okay.
It's inclusive of the 3% because it's under 4%. So that's
right.
Everything. Yeah.
Just wanted to make sure. So the reality is this: everyone in the nation that has a mortgage, 65% of them have under 4%. You are going to be in a hunt unless the job market catastrophically fails, which after COVID, I'm not in a position to ever have a crystal ball. Let's put it that way, right? Yeah. I mean, we have had big cities at this point, and you brought this up yesterday, Jason. LA is where you were born and raised, and is very sad of what's happening in LA. San Francisco, I'm born and raised, very sad of what's happening in San Francisco. And it's because of big businesses, the Googles, the Facebooks, and alike. They don't need the office space because of COVID anymore. The culture.
And they don't want to be in such business unfriendly places.
Correct.
I mean, California chases business out of the state. They hate companies. They hate employers. They hate landlords. Don't invest in landlord unfriendly places. Just avoid left-wing environments. That's the rule, right?
Yeah. And so the reason why it's so imperative for Jason to share this, and I want him to be on as many times as he's willing to be on, for all of you out there, if you're just getting started, the reason I make the statement now is the best time, because if you don't do it now, you just won't. You will be one of those people that Jason talks about that waits on the sidelines to speculate and speculate and speculate. And what I believe and what Jason is proving to you is you're going to be sitting there for a very long time. There's not going to be this moment of mass foreclosure, let alone mass defaults, which would be pre-foreclosures. And here's another thing that Jason hasn't touched on that I know very clearly, because he and I both have the luxury of sitting in these rooms. We just haven't discussed it. I've been sitting around a lot of hedge fund managers, and guess what they have? Billions and billions of dollars waiting for their sign to pull the trigger on specifically single-family assets. Specifically. There's also funds that are going to go into the commercial and the apartments and all that. But if you think for a second that this market is going to downturn at any catastrophic level at all, let alone marginally, you are just going to sit on the sidelines forever. And that is why I will tell you, from what Jason statistically is showing you, and what I've been yelling from the mountaintops based around gut understanding, I've done this for 15 years, is the hedge funds weren't around in 2008. If they were, the real estate market would not have taken the hit that it did, but they weren't. And if the real estate market, because of what the Fed has done, at some level in 3, 4, 5, 6, 10 years, does want to take a hit, well, they will be right there. And they're not going to let the deal go all the way down so the little mom and pops can get the deals that they can't, because their money costs them a lot less than my money does. It costs a lot less than Jason's money. They have the cheapest of money, right?
Yeah, they do.
They are going to be able to pull the trigger when we're still sitting here waiting and hoping it's going to continue to fall.
And before we wrap it up, though, Justin, and I appreciate you keeping the interview kind of short, but I do want to share one more thing that I think is really important, at least one more point. Let's look at what's been built coming out of the Great Recession, okay? Obviously, going into the Great Recession, it ramped up in 2004, 2005, 2006. We had a building boom going on, and there were so many properties being built. It was crazy, just a massive oversupply of homes. And then everybody got hurt in the Great Recession. And so the building came to a screeching halt. I mean, home builders suffered financially. Many went bankrupt. They just stopped building. They pulled the reins in and just stopped. And bank financing stopped. So that wouldn't allow them to build because they couldn't raise money for their projects as easily. And so that took a long time to sort itself out. But they also just psychologically became very conservative after that. And so we saw this massive shortage of supply being built in the last decade. There was hardly any new homes built. And if you look at this chart, it just shows you the historical trend of 2008 up to 2020 was just a complete deficit of construction, right? Mm-hmm. Now, what's even more pronounced, and you don't see it on this chart, but I'm just going to tell you, and I don't need to show you anything because most of you that are just aware of what's going on in the world, you just intuitively know this, what I'm about to say. And that is that this shortage is dramatically more acute in the entry-level housing price ranges because those properties have become very unprofitable for builders to build. I mean, how many builders, show me the builder building $200,000 houses.
Yeah,
you can't
none.
do it. It simply doesn't exist. So now, like an entry-level home from, say, D.R. Horton or KB Homes, those are the builders that build, cheaper entry-level homes, they're $350,000, $400,000. Yeah. That's the new entry-level home. The average new home price, or median new home price, is $475,000 in this country. No builder can make a profit building cheap houses. Yeah. So there's this huge shortage. So if you're playing in that market and you're thinking, oh my gosh, the economy is a house of cards, which you're not wrong about that, okay? Because the economy is pretty precarious. I'll be the first to agree with that. But you catch people as renters or buyers when you decide to sell the property, either moving up and forming a new household or moving down because they've had troubled times. And you're going to catch them in your low-priced, entry-level, bread-and-butter rental property. So that's the market in which you should play. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.